Hey guys, welcome to another episode of Stuff Your Accountant Isn't Telling You. Today we are back with another awesome episode, and today we're going to be talking about a topic that seems to be very difficult for a lot of people, and that is how taxes work. Now, I know when people hear about taxes, it's kind of a dreaded topic. Not a lot of people like to talk about it. They just know it's necessary, and to a lot of business owners, it's a necessary evil, but it is a part of doing business. And for you to be successful in your business, you need to understand how taxes work. And a lot of the complication oftentimes is that a lot of people just don't get it. It just is very complex. A lot of times it's not explained very well. So, this episode, we're actually going to talk about how taxes work. And to do that, I'm going to be sharing an episode that actually Terrell did a mastermind with a small group of people where he actually walked through the presentation. And it was a really great discussion on how taxes work and just different things to take into account when you're thinking about how your business taxes work as well as your personal taxes. So, I hope you enjoy the episode. It's going to be great. And as always, we always talk about on the show, we take complex topics and break it down in a way that is easy for you to understand. So enjoy the episode and thank you for listening.
To start it off as I will tell everyone is that taxes they can be confusing, and it is a complicated process. And there's a couple of reasons why taxes are complicated. And it's not just like one thing. And if you just figure out this one thing, then you figured it all out. But I mean, there are pretty much three kind of critical areas: is the way tax law is created, the way that tax law is implemented, and then also the multiple legal jurisdictions, which I'll go through that in a little bit. But in a perfect world, this is how tax law, it is designed to be created. Like if you were to look up the Constitution, or look at the laws and the process, at the federal level in the United States, and even in many individual states, this is kind of the process that usually it goes through. And if it's at the state level, instead of having the president, you would have the governor. But this is the process that it should go through. Now, if this was the process that tax law followed, it wouldn't be as complicated. But the reality of it is the way that tax law actually gets created looks a lot more like this. And this is why I tell people is that this is why tax law is pretty complicated. And then when you also add the fact that most of the people who serve on these committees, most of these people who serve in, whether it's the House of Representatives or Congress or the president or the cabinet, most of the people who serve in those positions are not accountants. So they don't always understand the things that they're advocating for, or the rules that they're asking for, or the things that they're voting on. They don't always understand the implications of those decisions, which is why we do have a quite complex a tax kind of situation in the US as far as answering questions, which is why I preface it with our tax code is several thousand pages long. So I may not know every single answer to every question you ask. But like I said, I will do my best to provide you with the best context. Now, that's the whole tax creation and then the implementation process. And then the last part that I do want people to understand is on a jurisdiction level. So the way taxes work is that you have income taxes at the federal level, at the state level, and in some places at the local level. Like my wife and I, we live in Pineville, North Carolina now. We used to live in Ohio, and where we lived in Ohio, we paid taxes at the federal level, we paid taxes at the state level, and we paid taxes at the city level on our income. So income was taxed at every part of the government wanted a piece of the income. So now not every state or every locality functions that way. But that's what makes it a little complicated, is that every level of government has the flexibility to set rules the way that they kind of want to set rules and stuff like that. And that becomes important, especially, considering that 2024 is going to be a big election year. And one of the things that you will hear in an election years, you're going to hear a lot more about people providing their perspective or their talking points about, how this may impact you and the taxes. So what I always tell people to do is you're going to hear a lot of conversation about what's happening at the federal level, but you can't ignore the fact that there are also changes that happen at the state level, and there are also changes that happen at the local level that you do want to be aware of, because it all can have an impact on you. Now, to give you a couple of examples, here are a couple of, like I said, pretty, what I would call unique tax situations or tax rules that aren't the same in every state. Now, I'm not going to go through every one of these, but I'll go through a couple of them. So I think it might have been maybe back in the 90s when Michael Jordan was playing basketball. There were some rules that came out, and they created this thing, what they call the jock tax, where some states were saying, well, if Michael Jordan is playing basketball in LA, although he plays for the Chicago Bulls, then if he's playing in LA, we should be able to tax some of his income when he has away games in LA. And so they started coming up with these rules of, for athletes, as they're playing on the road, each state that they play in now kind of has a right to be able to tax a portion of that person's salary in the state that they're playing in. And this was something that some states looked at because some states were like, hey, it made sense to them. And so it added a little bit more complexity. One of the other interesting ones is a playing card tax. So in the state of Alabama, if you buy a set of playing cards, there is an extra, there's an extra tax that's added to playing cards in the state of Alabama. Now, why they came up with it, I don't know. Maybe they want to discourage people from playing cards in the state of Alabama or whatever, but now the tax only applies if you buy a pack of spades. Now, if you buy a pack of Uno cards, the tax does not apply. But if you buy a pack of spades, the tax does apply. And so I would say that's just another example of like some of the I guess you say the variety of tax situations. The last one I'll talk about is the bagel tax. So if you ever go to New York and you ever complain about like why bagels cost so much more money, and that is because in the state of New York, there is an extra tax that is applied. If you go to a store and you buy a bagel, if you buy the bagel whole, it's going to be one price. If you ask them to cut the bagel in half, the price, you're going to see a pretty decent change in the price. And that is because in the state of New York, if they cut a bagel for you, they are going to be charged an additional tax for that, because for whatever reason, it changes the state of the bagel or whatever. So they got to pay an extra tax for that. So if you ever go into a bagel shop and you ask them to cut it and they change your price, that's kind of why. And so, as I was saying, I mean, those are just examples of how each state kind of has that flexibility of setting their own rules. So we won't deal with all of the different states. We're going to spend the rest of the time kind of talking more so from a federal tax level, because like I said, you have people from different cities on. Mostly everybody's from North Carolina, from the ones that have commented in the chat. But you may have some different rules depending on what part of North Carolina you're in. But one of the common questions that I do get a lot of times is, people are asking questions about like, your tax filing status, like, your dependents and what can you add? And so I did have to do, I did have to clarify this for some people. And because again, this was some horrible advice and some horrible stuff that I have been seeing on social media that I'm like, okay, all right, let me make sure that I include so people understand what is real, what is fake. So first one is, I will say is, as much as people love their pets, your pet can never be classified as a deduction on there's no status of single with a pet. And I know I have seen people, put that on social media. Even if you are married, as much as you may call your pets your fur babies, from the IRS's perspective, they are not the same thing as a human baby. So there is no deduction, there is no extra savings you get for, even if you are spending thousands of dollars on your pet. I would say, unless your pet is a show pet and you actually have like a business built around the pet, for the most part, your pet is not something that you can deduct on your taxes. And then also something that I've seen some people talk about is like where, hey, you're in a serious relationship, you've moved in with somebody, there is no tax status recognized for being in a serious relationship. It will have a financial impact on you, where it may save you or cost you money depending on, your personal situation. But from the tax perspective, they don't look at it that way. And I think also on a more serious note too, is when it comes down to getting engaged, a lot of times if people get engaged, let's say at the end of the year or something, do understand is that it is great that you have gotten engaged, you found someone that you're interested in, but it does not change your filing status in the eyes of the IRS. So it looks like we got a question that came in is, have you done taxes for disabled veterans where the primary income is from disability and tax-free, but the number of tax deductions? So I will say is, I personally have not done that. So I hope that answers your question directly. But I guess, do you have another question about things you should look out for, or questions you may have about a disabled veteran?
Yes, this is Tanya Arnold. My question is it worth filing taxes when the bulk of the income is tax deductible and they pretty much don't have any income that is taxable, but they have property, they have done property upgrades, they do have children? Is it really worth?
So I always look at that and answer it in I would say there's a couple of factors that I look at when answering that question is, from a legal standpoint, or I guess you say from an IRS requirement standpoint, the IRS has some thresholds of, if your income is over X amount of dollars, and I'll talk about that a little bit later, but if your income is over that amount, then you are required to file a tax return. And I would say is, if your income is not over that, then you're not required to do it. But I do think some of the other things you may want to consider is, let's say if that person ever wanted to buy another home, or let's say they wanted to take out a loan for, a child or a grandchild, or if they wanted to apply for sometimes like FAFSA, different things that you may apply for may ask you for a copy of your latest tax return. And so the thing is, if you're going in, let's say that person wanted to buy a vacation home, or they wanted to buy a property and leave it to their descendants. If you wanted to do that and the bank asked for a tax return, although you may not be required by the IRS to file it, but if the bank is asking for it, that may put you at a little bit of a disadvantage to be able to secure that loan or to make the transaction that you're trying to make. And so I would tell people to consider, different, factors of not just, hey, does the IRS require it, but do you plan on buying anything where you may need to show a tax return? If so, then it might be worth the effort of just going ahead and filing it. And if your tax liability is going to be very, very low, there are some options out there, I believe, that, do file it for free. So you can just have the document and the paper on hand. So Tanya, does that answer your question?
Yes, great answers and great examples of why to file.
Awesome. And so another question came in is, can you talk about taxes and deductions for small business expenses? What's the best course of action? So yes, I will definitely talk about that. And that is on my list right after I walk through this example. So I'm not going to forget your question. I will come back to that one and I will answer that. So when it does come down to the real tax filing statuses, I mean, these are generally these are your tax filing statuses. And I always put this up there so people can kind of understand which ones they are. And, at different stages of life, whether it's you or whether it's someone that you know that may be impacted by this. I mean, for myself, as I get older, one of the things that, have some friends who unfortunately lost a spouse to where it's like they didn't know about the status of a qualifying widow. But it is something to be aware of, whether it's you that's filing the tax return or whether it's just, someone that may be in that situation. So it's always good to kind of have a general idea of like what the different tax filing statuses are. Now, one of the things that I will note here is the married filing separate status is that I often get a lot of questions on that because people ask about, what are the criteria for, or what are the implications of if you're married, but you file separate from your spouse, because different people do that for different reasons. And it may be, it may be a financial reason. It may be a liability, or there may be one partner may have certain, financial investments or business investments that they want to keep separate because of liability, or maybe it's a partnership agreement, the way the business deals were structured. So it is a common thing that I have seen some people navigate. Now, you do want to keep in mind is if a person is married and they are filing separate from their spouse, there are some deductions that are not allowed. So there may be some things that you may look and compare what your tax return will look like when you're married filing jointly versus married filing separate. And you may notice that some credits you're not allowed to take if you're married filing separate. So that is something to keep in mind. So we got another question that came in is, what tax breaks are available for home upgrades, and do those breaks only apply to energy efficient upgrades?
Before we answer that question, as far as like this topic, since we're on this, and I'm sorry if you said this and I missed it, but how important will you say it is for the filing status though? Like how important will you say that? Because I asked this question specifically only because I've seen a difference within like single compared to head of household.
Yeah, so I would say there are some significant differences in, the filing statuses. I mean, one is the income ranges on the tax bracket are very different depending on filing statuses. So if you're single, you're probably going to pay the most taxes. Well, let me say your tax income brackets are smaller. So the amount of income that's going to push you into the next tax bracket is going to be smaller compared to head of household, qualified widow, and married filing jointly. So, and then also, like I said, there are some things that in your calculation, it does have an impact. And so you do want to make sure that you're picking, the right one for your situation. Now, I will say is please, please, please be on the lookout for if you have someone filing your taxes and they come back to you and they tell you, hey, you should pick this status because it gets you more money. That should not be the only reason why they pick that status. What you want to do is get them to explain, okay, outside of me getting more money because I picked this status, what other legitimate reason do I have for picking this status? Because one of the things that I tell people is that at the end of the day, the IRS will hold you responsible for your tax return, because even if you pay another company to file your tax return, somewhere on that tax return, you still have to sign your name to it. And in signing your name to it, you are confirming that you have read and you are not aware of any obvious errors. And when the wrong tax filing status is selected, the IRS tends to see that as an obvious error, unless there is a very legitimate argument there. So I would say is please make sure if you're getting someone else to file your taxes for you, please do not make a decision just because they're saying, hey, this will get you more money. there should be some other reason other than getting you more money to justify why they are recommending what they are recommending. So for the question that came up is, what tax breaks are available for home upgrades, and do those breaks only apply to energy efficient upgrades? So this is I guess this is where we get into the interesting part of the tax law is, so you have rules on the federal level and then you have rules on the state level. So what we would have to do is assess. So if we're talking about on your state income tax return, there are some rules in North Carolina where North Carolina may be trying to incentivize energy efficiency, or North Carolina may be trying to incentivize like water conservation. So there may be some different types of upgrades that you can do there and stuff like that. So you would need to understand the specific laws for the state and for the federal. But I would say in general, energy efficiency is probably going to be a pretty consistent one on the state and the federal level, which, I mean, could come from like the windows that you put in. I believe sometimes it may have an impact on as far as like the roofing, and if you go solar, or the types of doors and different stuff like that you put in, there may be all of that may fall under it as well. So I hope I am not directly aware of any other types of home upgrades that would fall under, I guess you'd say, tax breaks for an individual. Now, there are some other breaks. Let's say if you're operating a legitimate business, and I will repeat, a legitimate business, because I do not want to lose my license on giving you bad advice. So I would say is the business has to be legitimate that you are operating out of your home. There may be some of your home expenses that can also be categorized as business expenses. So it wouldn't necessarily be a direct upgrade, but a portion of it could be considered business expenses. So we have another question. What if any documentation needs to be provided for dependent parents that don't live with you? So when it comes down to proving for dependents that don't live with you, I'm gonna answer this in two different perspectives. So if this is a parent and let's say you are an only child, the documentation is not as stringent. You would just have to prove that you are providing financial support for this person, whether it's, hey, you can provide some documentation proof that you are paying their bills, or let's say if they're in a elderly community that you're paying the fees for that, or different things like that. You have to prove that you are providing financial support for that person. And I will say is, if they don't live in your house, you do want to make sure that your documentation is, more official. Not necessarily just say, hey, a letter that was written up that you sign on the file. You probably want something that is on a letterhead from a third party that you are paying, so you can show proof of that, yes, we are providing financial support for this person. Now, if it is a situation where you are not the only child and you have other siblings, you do want to have a conversation and make sure that none of your other siblings are also trying to claim this parent, because that could create a red flag if two tax returns go through and your parents' social security number and information is on two different tax returns being claimed as a dependent. It's going to flag in the system, which could create a world of other issues. So if you do have siblings, I would advise you to have that conversation, and just, be as clear about that conversation as possible, because I have seen situations where some of the siblings believe that they're providing more support than they really are. And so they ran into an issue because they just didn't have that conversation about like, hey, who actually gets to claim them, or who will claim them, or which one even qualifies to claim them on their tax return. So does that answer your question, Dee?
Yes, it does. Thank you.
All right, perfect. So this is probably the simplest way I can kind of explain the way your tax calculation works. And even with all the complexity of the rules, I will say is the calculation on whether you owe taxes or whether you get a tax refund, it follows these 3 steps. So if you're looking at a tax form, everything comes down to these 3 simple steps. Now, I will say the steps are simple, but they are not easy. There's a lot of complexity that goes into it, but this is the simple 3 steps. And the reason why I show this, because I tell people, is if you're paying someone else to do your tax return and you kind of want to understand, like, hey, what happened with my taxes and tax situation? What I would always say is get them to explain your tax return through these 3 simple steps. Because if they can break it down to these 3 simple steps, you can easily follow the math. And if something looks pretty off, you can easily ask a question or get some clarity, and they can kind of explain. Because I will say is a lot of people that I know, and even some of my clients, where our business, we focus on bookkeeping and CFO work. And we often interact with all of our business clients. We interact with their tax preparer who does their tax return. And a lot of times the clients are coming back to us saying, hey, we know somebody else is doing our tax return, but can you explain it to us? Because I don't understand what they're trying to tell me. They're telling me I owe money, but they can't really walk me through it. And so I always tell people is this is a simple way to understand and break down that calculation, so you understand whether you owe or whether you're going to get a refund. And so I'll briefly walk through kind of step by like each of these steps and kind of break it down so you understand it.
So there was a small business question. So it was funny that you brought up about the businesses, because there was a small business question. As a small business owner operating out of my home, at what point should I separate the filing of personal taxes and business taxes?
Yeah, so I would definitely say is that if you are planning to operate your small business on a consistent basis, you want to start having some separation. I think from just a organization standpoint, you want to actually treat your small business, separate from your personal life, because you want your small business to be able to sustain itself. And it's very difficult to do that if both your small business and your personal life are constantly commingled together. It's going to be challenging for you to really see how healthy is the small business versus what's going on in my personal life. And then I also think on a legal standpoint is when you kind of merge both your business and your personal life together, it opens you up to more liability. For example, if, and I guess, can you put in there, like, what type of business do you have? Because I could make it even more contextual to your specific business as well. But what I mean by the liability is, let's say if there's a mistake or an issue made within your business where, you're a travel agent. So let's just say if there is a trip that you plan for someone and, let's say some issue happened and they wanted to file a lawsuit. Well, if your business and your personal life are together and there is no separation, depending on how that lawsuit shakes out, you don't want to have your personal home or your personal vehicles or your personal bank account at risk, because in the eyes of the law, if both of them are all commingled together, then like there is no separation. Like they're not just suing your business, they are suing you completely because everything is commingled together. And so I would definitely say you do want to look at trying to separate those as much as you can if you're going to continue running this business as a regular ongoing business. Plus, I do think once you start to establish your business as a separate business, like you file for an LLC, or let's say you decide to be an S Corp or whatever, or a partnership, whatever entity you pick, you can, if it is clearly a separate business, it allows you to write some things off as a business expense Whereas if it's commingled with personal, you probably may have a harder time justifying it if it ever came up for an audit with the IRS. And so I always tell people is if you're going to run this business ongoing and consistently, try to aim to get separation between your business and your personal life as soon as possible. So the other question is, how can we itemize to bring down what we may owe? Okay, great question. I am going to answer that one as well. So I have not forgotten about that question and your other question about small business deduction. So I am going to answer both of those questions. But to give you some, I know, Alice, you asked a question earlier about picking the statuses. So this one gives you an idea on how like the percent tax rates are the same for everybody. But as you can see, the income levels may vary as far as what type of income falls. If you look at married filing jointly or the qualified widow, so to be in the 22% tax bracket, you see where your income has to fall. Well, versus if you were single, to where it drastically changes what tax bracket you fall in based on the filing status that you pick. Now, I'm going to walk through an example because I think this helps a lot of people kind of understand how the tax brackets and how the tax system works. So I will say we're going to look at, I'm going to walk through an example of a person that is single, and we'll walk through like kind of how the tax brackets actually work, because I do think a lot of times the way that it is presented on TV, when you hear about news or when people talk about what tax bracket they're in, I don't think we always explain it properly. So when you're in a certain tax bracket, not all of your income is taxed at that same level. And so here's an example of, let's say, a person who's making $150,000 a year. The way that the tax brackets actually work is not all of your income is going to be taxed at 24%. The way that they break it down, and this is why they call it a graduated tax, or we have a graduated tax kind of system where the first 9,000 is taxed at 10%. The next amount of money that falls between the 12% bracket, that's taxed at 12%, and then so forth. And it continues graduating up the scale. So for this person, not all of their income is going to be taxed at 24%, only a portion. And I say that because I talked to some people who have been afraid of making more money because they say, well, if I make more money, that's going to move me into a new tax bracket and I'm going to have to pay, instead of paying 22% on my income, I'm going to have to pay 24% on everything. And that's just not the way that it works. And so I think it is good for you to understand is that not all of your taxes are taxed at the same level. It is a graduated scale. And so as we go back to this kind of example, I'll walk through kind of step by step. So step one is really going to be your income minus your adjustments and deductions. And that's going to give you what we call your adjusted gross income. And so when it comes down to your income, here are all the things that fall into your income. Is whether it's your wages, or let's say if you're doing 1099 work, or all the 1099s you get at the end of the year. So usually you get them before the end of January, whether it's for, let's say if you did a speaking engagement somewhere, or you did some type of contract work. If you run a business, maybe you get 1099s from some of your customers that you've done business with. And also, maybe you filed 1099s. Maybe you filed 1099s to for the people that you pay that have done work for you. And also your business income falls under there. Certain retirement disbursements, if the retirement money that you're receiving is not tax-free, then that gets included in your income. Whether it's interest, money that you make from, you get from financial institutions for savings and loans, and then also investments, or if you have cryptocurrencies that you've sold. And then also, this is something to keep in mind that's becoming a bit more for business owners, is some of the free perks that you receive as a business owner could have a tax implication to it. I've done some assessments with some, I guess, social media influencers, and they may get asked to travel somewhere. And if they get asked to travel somewhere and let's say all the fees are paid for, well, what they don't realize sometimes is that some of that, the free stuff that they're getting from the IRS's perspective, probably might be taxable. So there's some stuff to keep in mind as the way we do business kind of changes. And then I think a last one that becomes very important for people to keep in mind is if your debt is canceled by, let's say, debt you have with the financial institution, if they write off your loan, it could create a tax event. So this became an even bigger topic when, all of the talk about canceling student loan debt. Well, normally when debt is canceled, the IRS views that as, well, that amount of money that was canceled of your debt, you need to add that to your tax return as part of your income. And that is normally what you have to do unless there is a specific law that says, hey, this canceled debt will not be included as part of your income. So that is something to keep in mind of whenever debt is canceled, that your canceled debt may need to be included with some of your income unless there is a specific rule that states that, hey, it does not need to be included in income. So we got a couple, yes. And I will say, unfortunately, there are a lot of people who have learned that the hard way because it's not something that unfortunately we hear talked about or people discuss. Because that was one of the things that came out when Joe Biden was announcing about like the canceling student loan debt. There were many accountants who were asking the question of, is this cancellation of student loan debt going to actually need to be included on people's, their tax returns? Even when it came down to like with the PPP loans, like the Congress had to make a specific rule to say the loan amounts that you are getting canceled will not be included as income. They had to make a specific rule because the general rule is canceled debt is considered income. All right. So the next piece, when it comes down to adjustments and deductions. So from a personal standpoint, normally when it comes down to adjustments, they're going to be things like, if you're paying for, your tuition and fees, the student loan interest, any medical expenses that exceed a certain level, or if you're divorced and you're making alimony payments, those should be deductions of your income. So you're not paying income on these things, which is why it's important to, keep track of these type of things. So, which is why like a lot of companies, if you're doing a retirement plan or a 401k plan with the company that you work for, there is a difference between doing a Roth or a pre-tax 401k plan and a post-tax. The pre-tax, if you're contributing money to your 401k plan pre-tax, that will be subtracted from your income when you do your tax return. But if you are you're making contributions after tax, that will not be a deduction of your income for tax purposes. So you do want to keep that in mind about whether you're doing pre-tax or after tax. And then also you also want to take a deduction for the standard deduction or the itemized deduction. So the standard deduction limits, they usually get increased every year. And so you can do one or the other. So if you are ever getting your taxes done and the person tells you they are going to take the standard deduction and they need you to track all your charitable giving, they're going to track all your home loan interest, all your interest payments on equity loans. If they're telling you they're going to do both, please do not pay that person to do your tax return because you cannot take both. You take either the standard deduction or the itemized deduction. If you try to take both, it will flag. I mean, if you're using any type of software, it's not going to allow you to take both. But you do want to keep in mind, you can take one or the other. And it's typically you take the one that is bigger. So if you are single or you are head of household, and let's say your head of household, your standard deduction is $19,400 that you can deduct from your income. Well, if you look at your home mortgage interest, plus any vehicle sales tax, plus any interest on student loans, all these other, and your charitable giving, if that exceeds $19,000, then in your case, it's better for you to take the one that is larger. So I hope that gives you guys some context on that. So if we go back to the example of the person who made $150,000, and let's say that person had some adjustments and they took the standard deduction, what we start to see is now we update their numbers for the tax calculation. Now what they're going to be taxed on is not the $150,000 that they made. They're only going to be taxed on the adjusted gross income, which follows, and we go through that same calculation again using the lower number. And that's kind of how you calculate that out. So the last thing I will say is credits and really figuring out whether you owe money or whether you're going to get a refund. After we did this calculation, what the IRS is saying is, okay, based on this person's adjusted gross income, they should have paid $26,000 in taxes. Now, some of that you might pay early. Like you may pay it like one check at a time, or you may make quarterly estimated payments throughout the year. So from the IRS's standpoint, they're saying, hey, between the entire year and up to April 15th, you should have paid $26,000. But if we look at some of the credits that you are allowed to take, and I know someone asked earlier about some of the home improvement credits, these are some other credits that you might want to be aware of as well. So I always tell people is take a screenshot of this. And if you're working with somebody else who's doing your tax return, is just ask them, hey, do I qualify for any of these types of tax credits? Do any of these types of tax credits apply to my situation? Because I think this will help serve as a way to help you kind of navigate, that conversation, because you don't know what to ask. So I would say just use this, take a screenshot on your phone, your computer, or whatever, and have that conversation with that person. And then also we're going to look at, like I said, any withholdings that you had from your paycheck or any estimated payments you make throughout the year. So as we said, the calculation we've been looking at, this person owes $26,000. And let's say if they paid between all the credits that they got and all of the prepayments, they paid $32,000 throughout the year. That is how we would calculate this person is going to get a refund of $5,300. And so that is how we simply walk through this simple 3-step on how your taxes are calculated. Again, you don't have to be the one to calculate it. If you're using, let's say, TurboTax, or you're paying somebody to do your tax return, they're going to go through that for you. But if you wanted to understand, hey, what happened here? What I would do is just ask them to walk you through the calculation of these 3 steps. You don't need to know all the details, but they can walk you through that calculation and it will kind of help you. We got a question. If you have not filed your taxes in 5 years, how would you go about starting back filing? So what I would say is if you haven't filed your taxes in the last 5 years, really what you're going to do is you're going to go back to the last year that you did and just start. You would have to file it by paper, because I don't think that they'll let you file that electronically for that far back. So you would have to collect whatever documentation that you have and then fill out the tax forms and mail those in up until you get to the current year, because I'm not aware of software that allows you to file those back years electronically. So I would say is start with whatever documentation you can get your hands on. Like if you were working a job then, get a hold of your your form W-2s from back then. Maybe you contact your employer, or if you're working for the same employer, maybe you can get that information there. If you were running a business back then, you would have to kind of put together what your how much money did you make from your business back then to kind of bring that together, so that you can actually start filing those tax returns and get that caught up for those 5 years. And I will say is, there may be a penalty that you may have to file if you owed money during those 5 years. And I will say the IRS is probably not I would say is that's the way the IRS handles it is, if you owed money during those 5 years, you're probably going to get a penalty, and there may be some interest that's added to the money that you owe. Now, if the IRS owed you money, you're probably not going to get any interest. They're probably not going to pay you penalties. They'll just give you whatever it was that they owed you. So I would say is you do want to try to take action on that as soon as you can. This last part, I'm going to go through I'm not going to go through every piece of this, because like I said, I did an entire session on what I call the stay out of jail plan. And this was because I just saw people giving bad advice. And so I created this whole series that I did called the Stay Out of Jail Plan. And it really focuses in on, the common mistakes that I see people making that leads to challenges. And for time's sake, I'm not going to go through every single one of these, but I did want to bring it up, and because I do think that it is important to see. But before I do that, another question popped in. Is cash value from life insurance policy taxed? So that one can be a interesting one, because some of the rules around life insurance policies, like if this is a life insurance policy that you receive from someone who passed, like if you were the beneficiary of it and you received it, then typically that's not a taxable event. If you're the beneficiary, it's not taxable to you. Now, if you're talking about the cash value, I would say we would have to have a little bit more conversation to really understand the details of your specific situation. But in general, if the value of something increases, then it usually isn't a taxable event unless you cash out. So one of the probably biggest examples, especially here in North Carolina, if you owned your home before 2020, after 2020, housing prices really shot up. And so for many people, the house that you live in now is worth more money than when you bought it. The thing is, you don't have to pay taxes on the increased value unless you decide to sell the house. Now, depending on what your financial situation is, there are some talk of different politicians who are trying to push for there to be a wealth tax, because the thing about it is cash value, if you have not liquidated your life insurance policy, the cash value is really just a wealth thing, similar to your house. The value is there, but you haven't sold it or you haven't liquidated it, so you don't actually have access to the cash unless you sell it. Now, if the politicians who are pushing for a wealth tax, if that moves forward, then it might be a slightly different conversation depending on, what your net worth is, because in some of the policies they're pushing for, they're wanting people to pay taxes on the change in value of something, even if they haven't sold it yet. So I will say is, depending on your specific situation, the cash value question may change over time. I hope that answers your question, Yolanda. All right, so one of the things that I will say is, the first thing I would say is, when it comes down to staying out of jail, the very first thing I always tell people is there is a very big difference between tax evasion and tax avoidance. Tax evasion is what gets you sent to jail. Tax avoidance are legal strategies that allow you to reduce your tax liability. So these are things that the tax code actually lays out that you can do in a very legitimate way. Now, if this is, usually tax evasion, it's going to be kind of obvious what is tax evasion, because you are intentionally trying to hide income. You're intentionally trying to play in the extreme gray areas of the law. And if you're doing stuff like that, then you are really going to run into some issues. Like, in fact, on one of the podcasts that my wife and I do is we do this segment called Tax Tea, where we literally go through the IRS's website and we look up the tax cases where people are going to jail for whatever craziness or foolishness that they're doing. And a lot of times it is craziness and foolishness, where we go through that and we just talk about, here's the situation that happened. Here's why that person got in trouble. Here's why that person should have known better, because this is just clearly tax evasion. And you would be surprised if you went to that website, literally every single day, there are 4 to 5 people who are getting sentenced to jail, or people who are getting very severe fines for the crazy tax evasion issues. And like I said, literally, if you go to the IRS's website and that page, you will see every single day, and they list it out for today's date, March the 8th. Here are the people who got charged today, or here are the people who are going to jail today. You look at March 7th, here are the people who are, so 5 days a week, people are going to jail for tax evasion issues that they are doing. And many times it's people are going to jail for stuff they did, for 3 years ago. So it's not that, hey, I filed my taxes this year, I got away with it. It doesn't pass the statute of limitations. Sometimes the IRS does go back and look at stuff backwards. So you want to make sure whatever strategies you're using, that you are using legal tax avoidance strategy and not tax evasion strategies. And so before we run out of time, one of the questions I wanted to answer, the question that someone asked about the business taxes. It was, can you talk about taxes and deductions for small business expenses? So this is one area where a lot of people get into issues with tax evasion versus just outright fraud. I mean, to be honest with you, is where the reason why I harped on before is a legitimate business. Like, a legitimate business isn't like, hey, we bought an investment property, we make absolutely no money on the property, we have no plans of making money, we're just using it to take losses so we can reduce our liability. What I always tell people is a legitimate business has an objective of creating a profit. Like, at some point, that should be the plan. Now, the IRS often says that if your business is losing money for 3 consecutive years, it goes under review of whether the IRS is going to call it a hobby or whether it is a legitimate business. So you do want to make sure that when we are talking about a small business, that it is a legitimate business that you are running. Now, what I will say is the general rule is for expenses to be considered business expenses, it really does come into like the nature of your business. Like, is this like the rules the IRS says, is it necessary and ordinary to the type of business that you run? Now, I have had conversations with people where they talk about, well, me getting my hair done, me getting my makeup done, or me buying these type of clothes or whatever is part of my business because I travel. And what I would ask them is, well, what type of business do you run? And they're like, well, I run a dog walking business. So I'm like, you're gonna have an interesting time trying to explain to the IRS why all of these expenses are necessary and ordinary to your dog walking business. I'm not saying that you can't do it. I wouldn't advise you to do it, but you're going to have to explain the gap between the two. And it's one of those things that we see it like now that we're in it is interesting to keep in mind is now that we are in a world where people can work remotely from just about anywhere. A lot of people are like, well, I'm just going to go, travel here and work from here. And as long as I open my laptop, then, this should qualify as a business expense. What I would tell them is, if the IRS were to audit this and they were going to ask you the question, is this an ordinary or necessary part of you running your business? Or was this, you just wanted to take a personal trip and you happen to take your laptop with you? So you do want to keep that type of stuff in mind. And you do want to be aware of, is this ordinary and is this actually related to me running my business? And sometimes like when, like I have clients that are spread out throughout the US. Like we have clients as far as, California and Seattle and all the way down to Miami and some even in New England, to where we have clients all over. So a lot of times when we're traveling, we're making stops in destinations where we have clients. And I will say is, I don't necessarily write off 100% of the trip, because not every trip I take is going to be business related. Now, I probably could finagle it to make it look like that. But one of the things that I realized is that, is it really worth the hassle of, if I get audited, one is, and it doesn't come back good, I could lose my license. Plus, being audited is going to be a huge distraction from me actually running my business. And so while it is good to take every legitimate business expense that you can, you do want to ask yourself, is this ordinary and necessary for the type of business that I am running? So I hope that answers your question. And what I will say is, on the best course of action, what I would definitely say is, if you're running a legitimate business, you do want to make sure you have some type of tracking system for tracking your expenses and your income. Like for a lot of small businesses, they start off using something like QuickBooks or an accounting software like Xero. And one of the good things with a lot of those is they have the feature now to where if you go out on, let's say you go out for a business lunch and you get the receipt, you can actually take a picture on your phone and load it directly into your accounting system. So you don't have to keep a shoebox of receipts or a shoebox of papers and stuff like that. So I would say is, you definitely want to get some type of, accounting system to track your numbers, and look at one that has features where you can load your actual images of your receipts, so that you aren't, having to keep up with all these pieces of paper everywhere. The other thing that I would say is, you do want to run it like a business. Again, I know I mentioned this earlier about the mixing personal with business. You do want to run it like a business. So you do want to make sure that, hey, if somebody, and I always tell people a general rule, if you were going to sell this business one day, would a person look at your business and say, hey, this is a clearly defined, well-run business that I'm willing to pay money for? Or would they look at this and say, this looks more like a personal hobby that you're doing that you sometimes make money on? So you do want to look at it that way and say, hey, am I running a truly legitimate business? And I will say is, for many people, is you may start off using an Excel spreadsheet or a Google spreadsheet for tracking your information. And I think that is great. I will say is, as you start to grow your business, it may be worth it to look at an accounting system that's going to actually integrate with your bank account, to where you have your bank information going directly into the accounting system. It kind of helps with making that organization. But that's as your business starts to grow, and because there is an expense to using a system like QuickBooks and stuff like that. So I always say is, if you have to start simple, there is no shame in starting simple and starting with an Excel or a Google spreadsheet. But as you grow, you do want to look at a little more sophistication in your systems. And I would also say is, one final thing to that is, make sure that you set up a separate bank account from your personal account, especially if you're going to be accepting payments through like Cash App or like Venmo or PayPal. You do not want that attached to your personal name. You don't want to receive money for your business in your personal name, because one of the things that the IRS has changed is that Cash App, Venmo, PayPal, they are now filing reports with the IRS saying, hey, we sent X person X amount of money. The IRS is expecting that to show up as income on your personal tax return. So you do want to make sure that in treating the business separate from your personal life, that you do have true separation and treat it like a legitimate business. And so I will stop there. So I will say thank you so much for having me.
Hey, it's your girl, Tia Robertson. I'm the host of Entrepreneur Insider. Right here on RETV, every Thursday at 6 p.m. Eastern for entrepreneurs and news that you need to know about. See you there.
Welcome to What's Going On? My name is Demita Joe. Each Wednesday, you can find me here at 3 p.m. I'll be over here discussing different things that are going on and try to bring you a boost of positivity for your week because we all need this. We're going to share some feel-good stories. We might find a hometown hero. We may take a look at some trending topic. And sometimes we might even find a lesson in a not-so-warm and fuzzy story if we can. I'm Demita Joe, and I'll see you guys on the next episode right here on What's Going On?